I want to be fairly direct here. It is already 5:15. Explain with calculations how the financial asset will be accounted for if Kinks has a business model to hold the bonds until redemption date. Well, I think we know the answer, and the answer is amortized cost. Okay? Kinks has a year end. It bought 100,000 5% bond for 95 and incurred transaction costs of 2. Interest is received in arrears. The bond is due to be redeemed at a premium of 5,960. The effective rate is 8%. The fair value of the bond is this, and the fair value of the bond is that. So the cash flow test is met. Yeah, the cash flow test is met in that we've got very specified payments which contractually represent repayment of interest and capital, and we are going to hold to maturity. Yeah, there's going to be no sale. There's going to be no sale. So there is my very aggressive explanation. And now what I want to do is show you the numbers. Do I want to show you the numbers? Yes, I am going to show you the numbers. Amortized cost. Let me be momentarily slow here for a second. What's the opening balance? 100, 95, 102, or 97? I am buying the investment. I am paying money out. So I am buying the investment. I'm not raising finance. I'm not borrowing. I'm not looking at the net proceeds. I'm looking at the fair value plus the transaction costs. What would be the initial recognition? 97. I've paid 95. There are transaction costs of 2. That's where I get 97 from. What is the effective rate in the P&L? 8%. How much cash do I receive? Coupon rate, nominal value. How much cash do I receive? Every year, at the end of the year, I receive interest. How much is the interest? How much is the cash that I'm receiving? 5,000. So therefore, the asset that I have at the end of the day is 99,760. Now, I bought this asset on the 1st of Jan, X1, and it's due to be redeemed in December X3, 1, 2. So it's only 3 years. So I'm going to chase it down to the death so you can see everything that happens. $7,981. 102.74. $82.19, and then we have the redemption. And being redeemed at a premium of 5,960. So when we redeem, we pay back the 100, and we pay back an extra 5,960. So we pay back an extra 5,960. And hopefully that gets us back to nil. So 102.741 plus 82.19. And that gets us back to...
Yes.
Yes. Yes. Amortized cost. I'm lending somebody some money. It's cost me 97. I've invested 97 in the process. My effective rate of return is 8%. This would represent my asset at the end of the year. Now, the fact that the fair value of the asset is 110, and the fact that the fair value of the asset is 104 is irrelevant to me if I'm accounting for the asset at amortized cost, because I'm not interested in the fair value, because I'm not interested in selling the asset. So amortized cost means don't worry about the fair value. Amortized cost means don't worry about the fair value. The business model is to hold. So you're never, ever going to sell. So you're not interested in the exit value. So this is how we account for it in terms of amortized cost financial asset. But there is a part B. In the context of part B, the business model, so the cash flow test is met. The cash with the business model, the cash flow test is met. But the business model is that we could sell these bonds if a higher return became available if we decided to. So therefore with B, it is fair value through OCI. Basically the cash flow test is met, and we may sell. The cash flow test is met, and we may sell. I'll do year one. I'll do year one. You can do year two. But I'll do year one. Now, I'll do year one at a pace which I think is relatively slow. Kinks has a business model to hold the bonds until redemption, but also possibly to sell them. So if we're interested in possibly selling them, then it's fair value through OCI. So I will have an asset, I will have a non-current asset, I will have an investment which is fair value through OCI. And at the end of the first year, it will be a fair value. How much is that fair value? How much is that fair value? 110. Let me tell you something for nothing. tell you something for nothing. The P&L will still have the interest. The P&L will still have the interest income. 7760. The P&L will still have the investment income. 7760. What's the gain? What's the gain? No. No? That tired? 10,000, carry on.
Minus the transaction cost.
What's the year-end fair value of the asset? What's the year-end fair value of the asset? 110. What is the carrying value of the asset at the end of the first year? Correct! 99,760. Yeah? So we take it all the way along. Whoops! 99,760. So the carrying value was 99,760, and therefore we have got a gain here of 110,000 minus 99,760, 10,240. And this gain goes to, well, it is a gain. Yeah, it is a gain. The asset has gone up. So this is a gain. So the gain goes to OCI. And the gain that goes to OCI is 10,240. And it's not recycled. Let's do the second year together. Let's do the second year together. Let me deal with that term recycling after the break. I would like you to repeat the question and let us deal with that term recycling after the break. So, first number I would like to know is this balance sheet number here. What is this balance sheet number here now? 104. Probably observable. Yeah, level 1, level 2, level 3, 104. Investment income, same. So investment income will be 7981. Now, I've got a problem here in calculating the gain. I'm in year 2. So I have an opening balance which has been restated. I have an opening balance which has been restated to 110. I have my P&L based on the original data. So I have my P&L of 7981. I have my cash of 5, and therefore I have my carrying value. So 110. 3 plus 7981 minus 5,000. That is giving me 112,981. I'm now in year 2 and I'm doing the fair value because it's called fair value through OCI. I'm now in year 2 and I'm doing the fair value. And it's the fair value through OCI. How much is the fair value in year 2? 104. How much is the carrying value? 112,981. So do I have a gain or a loss? Loss. And I take the loss to OCI. 8981. I take the loss to OCI. Back I go, forward I go. I've got a loss there of 8, 9, 8. we are looking at financial assets. And when we are looking at financial assets, we have quite a complicated classification process. And when we're looking at financial assets, the classification process starts with the cash flow test. Now, the cash flow test is met if basically it's a loan, so that the contract specifies, the contractual terms contain specified payments on specified dates which represent interest and principal. If that is the case, it's debt. And if you're never, ever, ever going to sell that asset, amortized cost. If you might sell it, fair value through OCI. If you are definitely going to sell it, fair value through P&L. If it fails the cash flow test, then you bought some shares, because you haven't got contractual payments coming back, you haven't got a fixed return. So if it's an equity investment, because it fails the cash flow test, it must be at fair value. Normally fair value through P&L, but it could be fair value through OCI, but only if you make an irrevocable election, and you have to do that at the beginning. Not straightforward. Not straightforward. It will need your attention to have a look at it again. Now, I've still got a little bit more to do on financial assets. I've got to clarify about recycling, because I keep using the word and perhaps not everybody is familiar with it, so I need to clarify about recycling. I also need to talk to you, when we finish financial assets, also need to talk to you about derivatives. Okay, so we need to think about hedging and derivatives, and that's going to take a little bit of time, but I'm also hoping that this evening we should have the opportunity of looking at deferred tax before we complete. But I'm making the time 6:15, and because it's 6:15, it's about break time, isn't it?
Yes.
It's that time. It's that break time. So let us recharge time. Let's plug ourselves in, get a bit of extra battery juiciness, and let's reconvene, please, in 1 hour. Please reconvene in 1 hour.